If you make $80,000 a year and still feel tight, you're not irresponsible. The number sounds stable. The margin often isn't. John looks at his banking app on a quiet Tuesday night. His paycheck just landed. The number feels solid for a moment. Then he scrolls down. Rent cleared yesterday. Auto pay for insurance is pending. A credit card balance sits there. Not urgent, but not small. $80,000 sounds like arrival, but what actually stays? For many working professionals, $80,000 places you above the national median. It suggests comfort, security, maybe even progress. But income is a headline number. Life runs on the after-tax version. Let's walk through what that $80,000 actually turns into, using a simple illustrative example.
Assume a single professional living in a mid-cost metro area. Not luxury, not Manhattan, not rural, just somewhere with opportunity and rising prices. Start with federal taxes. After standard deduction, taxable income drops. Then federal income tax applies in brackets. Add Social Security and Medicare payroll taxes, possibly state income tax. Depending on location, that might be zero, or it might be several thousand. In many cases, $80,000 gross becomes something closer to $58,000 to $62,000 take-home annually. That's roughly $4,800 to $5,200 per month. The headline shrinks fast, and that's before rent.
Housing is usually the largest fixed cost. In a moderate city, a one-bedroom apartment might run $1,700 to $2,200 per month. In higher-demand metros, it climbs beyond that. Even conservative budgeting guidelines often recommend keeping housing below 30% of gross income. But 30% of gross is not 30% of take-home. At $2,000 a month, housing alone absorbs nearly 40% of net income in this example.
John confirms his rent payment. $2,000 gone in one click. The apartment is quiet, clean, functional, not extravagant, just standard.
But this is where it gets complicated. Housing isn't just rent. Utilities add another $150 to $250 depending on season. Internet might be $70. Renter's insurance may be $20. Small numbers individually, not small together. Now housing might sit closer to $2,300 per month. Out of $5,000 take-home, nearly half disappears before groceries enter the conversation.
And this is the part most people underestimate. Healthcare. Employer-sponsored plans feel manageable because premiums are deducted automatically, but that doesn't mean they're small. In this example, let's assume $250 per month in health insurance premiums. Add dental, add vision. Now maybe $300 leaves each month before the paycheck even hits the bank. But watch what happens next. That premium doesn't eliminate costs. It simply grants access. Deductibles remain, copays remain, prescriptions remain. An urgent care visit might be $150. A specialist appointment might be $300. A diagnostic scan could hit a deductible threshold quickly. Healthcare isn't necessarily catastrophic for most people, but it is consistently present.
Now, here's what makes this harder. Taxes don't just stop at income tax. Payroll deductions often include retirement contributions. Many professionals contribute 5 to 10% to a 401k to capture employer match. That's smart, it's responsible, but it reduces liquidity. If John contributes 8%, that's $6,400 per year before taxes, which is excellent for long-term wealth, but that money doesn't help with rent next week. So the monthly take-home number might already assume retirement contributions, which means the usable number is lower than it first appeared.
Now, let's talk transportation. Even if you work hybrid or remote, mobility costs remain. Car payment, $400 per month is common for a modest newer vehicle. Auto insurance, $150 to $250 depending on state and driving history. Fuel, $150 or more depending on commute. Maintenance, averaged monthly, $75 to $100. Transportation can easily reach $700 to $900 per month. If you live in a city with public transportation, that may drop, but housing may rise. The trade-offs shift, but the pressure often remains.
At this point in our example, housing, around $2,300, healthcare premiums, $300, transportation, $800, basic utilities and connectivity, already included in housing estimate, groceries, Let's conservatively say $500 to $700 for a single professional trying to eat reasonably well. We're approaching $3,900 to $4,100 per month, out of $5,000 net.
But this is where it gets complicated again. We haven't included student loan payments, subscriptions, cell phone bill, professional clothing, travel to see family, holiday spending, home goods, unexpected repairs, gifts, dining out occasionally. Even modest discretionary spending of $400 to $600 per month narrows the margin further.
Now, here's the structural issue. Most of these costs are fixed or semi-fixed. Rent doesn't flex downward easily. Insurance premiums don't negotiate monthly. Car payments are contractual. Health coverage is predetermined. Variable spending gets blamed most often because it's visible. But the majority of financial pressure usually sits in fixed commitments made months or years earlier.
John sits at his kitchen table, reviewing his monthly breakdown. Not stressed, not panicked, just calculating. He scrolls through categories. Everything looks reasonable. Nothing looks extravagant. Yet the leftover column feels thin.
But watch what happens next. Savings. If after all expenses there's $600 left in a month, that's $7,200 per year, which is solid, until an emergency happens. A single car repair can consume half that. A medical deductible can absorb most of it. A move to a new apartment requires deposits and fees. Airfare during a family emergency compresses a savings buffer quickly. And this is the part that creates the tension. $80,000 supports stability. It does not always support insulation.
Now let's shift the lens. Wage growth over the past decade has been real for many professionals, but cost growth has also been real. Housing in many metros has outpaced salary growth. Healthcare premiums trend upward. Insurance costs fluctuate. Auto prices have risen. The difference between gross income growth and fixed cost growth is rarely dramatic in any single year. It's incremental, subtle, compounding. Lifestyle inflation gets discussed often. And yes, some spending expands as income rises. Nicer apartment, better car, more travel. But structural inflation, rent, insurance, healthcare, education, operates regardless of lifestyle ambition.
Now, here's what makes this harder. Income arrives twice per month for most professionals. Obligations are scattered across the calendar. Rent on the 1st, insurance on the 10th, credit card due on the 15th, car payment on the 20th. Cash flow timing creates psychological compression, even if annual math technically works.
John glances at his calendar reminders. The numbers don't scream danger. They just require coordination. Fixed versus variable pressure also shifts how it feels. Variable spending feels optional. Fixed spending feels immovable. When most of your budget is fixed, flexibility feels limited, even if income is objectively strong. This is where the experience becomes psychological. On paper, $80,000 is respectable. In practice, margin feels narrow. Saving feels slow, not because nothing is happening, but because progress competes with stability. Retirement accounts grow gradually. Emergency funds take months to build meaningfully. Investment gains are invisible day to day, but rent is visible every month. Stability can feel temporary because the buffer is thin, not non-existent, just thin. One disruption, job change, medical issue, relocation, can shift the equation quickly, not into catastrophe necessarily, but into recalibration. John sits with his laptop open late one evening. A retirement dashboard glows softly. The balance is growing. It's not small, but it's not freedom yet either. Outside the window, the city hums quietly. Everything looks normal. Everything is functioning. And that's the quiet reality. Many professionals earning $80,000 are not struggling in crisis. They are managing. They are paying. They are saving something. They are progressing. But the emotional gap between the headline salary and the lived margin creates tension, because the number sounds like more than it feels. There's no villain in this equation, no dramatic collapse, just layered obligations interacting with a modern cost structure. Housing, healthcare, transportation, taxes, insurance, food. Individually reasonable, collectively heavy. So when someone says they make $80,000 and still feel tight, The explanation is rarely reckless spending. It's arithmetic combined with structure.
John locks his phone before going to bed. Tomorrow's paycheck cycle will repeat in 2 weeks. The numbers will move again. Bills will clear again. Savings will inch upward again. Nothing dramatic. Just the steady rhythm of modern professional life.
$80,000 isn't failure. It isn't wealth either. It's a middle layer of stability, navigating rising layers of cost. And when the margin feels thin, it's often not about mismanagement. It's about what the number actually turns into after everything takes its portion.
If this perspective felt familiar, you're not alone. You can share your experience in the comments, not for debate, but to add context to the reality many people quietly live through. And if you want more long-form documentaries about the hidden financial systems shaping everyday American life, you can follow The Hidden Cost.